Let's talk growth versus value. The iShares Russell 1000 Growth ETF, that's the IWF, is on a 5-week winning streak. That's its longest since last August. Meantime, the iShares Russell 1000 Value ETF, IWD, fell more than 4% last week. That was its worst weekly performance since last October. Joining us now, Jacob Walther. He's co-founder at Blueprint Capital Advisors, and Stephen Whiting, chief investment strategist at Citi Global Wealth, to talk about all of this. Stephen, let's just start with this little bit of an unwind of the value and cyclical stock outperformance. It was something that's gone on globally, seems to have been accelerated, if not triggered, by the interpretation of what the Fed did last week, but value still outperforming growth year to date. So where does that leave you with regard to how to position?
Well, look, we have an economy that is seeing the most rapid shifts in history, and we are going to have markets that reflect that. So we viewed this year as a year in which value cyclicals would outperform. Those turning points for the economy, the big cycle, end of cycle shifts, get these mean reversion trades, but ultimately we'll head back to a growth market. That'll be when we're really pricing in a complete recovery from COVID. I think now, if we take a look across the world, there are still going to be recovery trades from this. So I don't think that what we had, what you mentioned, is an unwind related to Fed policy, a lot of aggressive positioning in the short term, that's going to mean the end of those recovery trades. But they're not long-term growth. They're not long-term drivers of outperformance, and will eventually settle back into a market that has a significantly stronger component for growth.
Jacob, we do still have a U.S. economy set to grow perhaps 10% real this quarter. Earnings growth for the S&P tracking up 30% for 2021, and credit conditions still look pretty good. I mean, it seems like not a lot of the major inputs have changed that much, but what was your thought in terms of the market action last week and what it says about either policy or opportunities from here?
Look, I think we're seeing an unwind of the reopening trade, and it's been just that, a trade. You had to know when to get into value, and you had to know when to switch back to growth. I have solidly been in the growth camp since 2016. The Fed continues to tell us that we should be in the growth camp. The 10-year continues to tell us that we should be in the growth camp. And I think that when you look at the value names, they rallied simply because the relative valuations were at a 20-year low. And now since September of 20 up through May of this year, that we've seen them sort of double the performance leadership of growth names, you're starting to see investors focusing again on companies that can not only benefit from cyclical economic growth, but also long-term perspective fundamentals. And that leads us right back to a lot of the big technology names and away from a lot of the economically sensitive names like basic materials, financials, and industrials.
You mentioned that the 10-year yield is among the things that are informing you that, growth seems like it's got advantages here. Do you think that's strictly a valuation thing? Or, in other words, it kind of, makes growth stocks relatively more attractive longer term? Or is it telling us something about the actual economy decelerating more than expected or something like that?
I think the answer is all of the above. At the end of the day, it's the rate that we use for dividend discounting. And so when that rate is lower, it certainly makes a company's performance look a lot better. It's also a symbol of how the economy is doing. As that rate starts to go up, I think people are generally trying to forecast how the Fed is going to move. And given that they've already signaled to us that they're not looking at tightening until sometime in 2023, I think we can take some comfort that inflation is contained, and that certainly a rise in the 10-year rates will not disrupt the performance of growth stocks.
Stephen, how would you characterize the pacing of the global recovery? I mean, it seems uneven depending on where you look, and maybe the kind of slower nature of some of the comeback in parts of the world are also what some of this bid in the bond market is about.
Well, that's the thing about some of the cyclical trades. There are places in the world that still have only recently felt all but hopeless about COVID, about reopening. their larger recovery is 2022. Now, if we were to take a look at cyclical value trades in the U.S. small cap market versus those in Europe or Latin America, for example, we've progressed a lot more. And we do think that we're going to have those bounce back effects in some other parts of the world. So part of that, again, is still a pretty good opportunity. It might actually outperform growth stocks over a 12-month period of time. And we haven't necessarily seen all of the upward interest rate pressure. The fact that the Fed will take 12 to 18 months if we have a rapid, strong recovery just to get to a very first rate hike, and then we'll go very slow, does suggest that we'll see some yield curve steepening again. So I'm not sure that the next 6 months will be the period in which you can't still find some very good cyclical recovery trades, but you have to build a portfolio with a transition, right? And staying in those companies that performed incredibly and protected us in the downturn in the early part of 2020 and have come under some pressure, we can't just say that that's the entirety of the portfolio, but we should be heading back into those long-term growth opportunities.
Shepard Smith here. Thanks for watching CNBC on YouTube.